Welcome back, everyone. I hope you enjoyed the lunch. Nice little break. Now, I spoke in my remarks earlier this morning about the importance of tackling market fragmentation once and for all. Too many divergent discrepancies have been popped up in the rules that have increased operational costs and complexity, and it's time we put this right. So to put this right, we have Stephen Kennedy, the head of our global public policy team, to lead this panel on the ways to unpack the issues of market fragmentation. Stephen, off to you.
Thank you, Scott, and good afternoon, and welcome back to our conference program. As Scott mentioned, we're going to be talking about the issue of market fragmentation. And to kick things off, I'd like to ask you a quick question. Has anyone here ever heard of the Golden Arches Doctrine? The Golden Arches, as in McDonald's Golden Arches. Anyone? Well, not long ago, I assure you, in the mid-90s, it was all the rage among the intellectual set. The term was coined by author and commentator Thomas Friedman, who wrote such books as The World is Flat. To summarize, the Golden Arches Doctrine posited that no two countries with McDonald's franchises had ever gone to war with each other. And the reason, according to Friedman, was because countries with middle classes large enough to sustain a McDonald's franchise had reached a level of prosperity and global economic integration that made war risky and unpalatable to its people. That's the Golden Arches Doctrine. Now leave aside for a moment your thoughts about Big Macs and American culture and cultural imperialism, because there's a larger point here. A more important point is that not long ago, there was a very deep and a very wide belief in the virtues of globalization, in the benefits of global markets, in the transfer of capital flows, in the integration of economies. Globalization and global markets were the path to rising living standards, wealth creation, and increased prosperity for all. And it depended first and foremost on a regulatory approach and structure that removed barriers to entry and leveled playing fields for competitors. Nowhere was this approach more important than in our business, than in the derivatives markets, which have traditionally been among the most global of financial activities. Now, the truth is, there's always been a gap between the concept and the reality of global financial markets and globalization. Individuals' jurisdictions over the years have differed a lot in the scope and substance of their approaches to facilitating global markets and in their regulatory frameworks. Some even rejected the idea of global markets entirely. But even amidst these differences, and even with these outliers, I think it's fair to say that the benefits of globalization and global markets remained the prevailing belief in the world's major financial and political capitals. And then the impossible happened. Two countries with McDonald's franchises went to war and broke out into armed conflict with each other. I know it's sad, but it is true. The Golden Arches Doctrine was a doctrine no more. And perhaps, tongue-in-cheek, maybe the benefits of globalization might not be as advertised. But then, more seriously and more importantly, came the financial crisis. To some, the crisis exposed the flaws of global financial markets. As former Bank of England Governor Mervyn King once quipped, global banks are international in life, but national in death. During the crisis, risks spread across borders, and policymakers grappled with how to address and mitigate the resulting problems, all of which has caused many to doubt the virtues of global financial markets and to think more about safety and soundness and competition within their own individual markets. This, in turn, has the potential to lead to fragmented markets and is giving rise to concern about inefficiencies and costs and risks that fragmentation pose to policymakers and to market participants. Now, that's the context for our discussion today over the next hour or so. As you know, the G20 has identified market fragmentation as a key issue to address this year. It's on the finance fast track of the Japanese G20 agenda. During our panel, we'll discuss what's driving these concerns. We'll examine how and where fragmentation is affecting financial and derivatives markets. We'll speak to what policymakers can and might do about it. For this discussion, ISDA is very thankful for our panelists for joining us here today, and it's my honor to introduce them. And I'm going to start with our friends from the official sector. To my right, a man who obviously needs very little or no introduction, Patrick Pearson, who is the head of financial market infrastructure and derivatives at the European Commission, who joins us from Brussels, and we're very thankful for that. To my left, Shunsuke Shirakawa, who is Vice Commissioner for International Affairs at the Japanese Financial Services Agency. To Patrick's right is Jenny Cosco, the co-head of Goldman Sachs APAC Regulatory and Government Affairs team. And all the way, and to Jenny's right is Steve Humenik, who is of counsel at the Covington law firm in Washington, but by this time next week, he will be a partner at K&L Gates in Washington. Steve served 2 terms of duty at the Commodities Futures Trading Commission in Washington. And all the way to the left, last but not least, is the board member, Thijs Aaten, who is the Chief Finance and Risk Officer at APG Asset Management, which is Dutch-based. Thijs is based in Hong Kong. They manage about $500 billion in different locations around the world. So that's our issue. That's our panel. And let's start with the questions. And Shirakawa-san, if you would, can you just kind of level set us? Why did the Japanese put this on the agenda? What are the issues you're seeing?
Thank you. Thank you very much. Thank you, Scott, and other ISDA colleagues for inviting me to this AGM conference. This is a very important opportunity for us to talk about the market fragmentation issue, which is, as already explained, one of the most important agenda for the Japanese G20 presidency this year. Thanks to almost 10 years of the effort made by the G20, FSB, and other standard-setting bodies, we have largely put in place reforms measures to enhance the resiliency of the global financial system. These include Basel III, OTC derivatives reforms, and resolution frameworks. On the other hand, our progress has been slow with respect to promoting an open and integrated global financial system, despite the individual efforts of G20 members. Regulations and supervisory practices that are inconsistent, overlapped, or incompatible across jurisdictions are putting an excess burden on some financial institutions. This could give rise to market fragmentation along national lines. Against this backdrop, we proposed market fragmentation as one of the priorities of Japan's G20 presidency. The FSB and IOSCO have launched an initiative to identify the sources of harmful market fragmentation and to explore ways to address any financial stability risks. So what should we expect by discussing market fragmentation? We are not intending to reopen the agreed upon international standards. Rather, we would like to discuss practical and pragmatic solutions for addressing market fragmentation. Our focus will be on market fragmentation driven by regulatory and supervisory measures, which negatively impact financial stability or market efficiency. Potential sources of market fragmentation driven by regulatory and supervisory measures can be broadly classified into 3 categories. The first category is inconsistencies in the implementation of international standards, either in timing or substance. The second category is extraterritorial application of market regulation or location policies requiring certain activities to be conducted in specific jurisdictions. The third category is incompatibilities between home and host regulatory or supervisory requirements. In order to seek variable input from stakeholders, including market participants and academia, the FSB and IOSCO hosted workshops in January and March of this year. Stakeholders took this opportunity to highlight examples where supervisory and regulatory policies may give rise to market fragmentations. First area identified was cross-border trading and the clearing of OTC derivatives, which are sometimes segmented along geographic lines. The second area was banks' cross-border management of capital and liquidity, which can be affected by local ring fencing or prepositioning measures. The third area was barriers to information sharing across borders, including differences in data reporting requirements. I will stop here, but I'm very much looking forward to working with other G20 members to address these issues.
Thank you. Thank you, Shirakawa-san. Patrick, from the EC's perspective, what would you add to Shirakawa's comments about concerns about, market fragmentation and your participation in the G20 initiative?
Yeah, let's talk about the F word, fragmentation. It's very interesting because in Europe, for more than 60 years, we have a truly integrated market with frictionless trade. I mean, anybody would aspire to be part of that market, you'd think. But even within the internal market in Europe, there's a different perspective on fragmentation. And I'll give you a competition perspective. So our competition people, very powerful people, good, great people, but powerful people in Europe, have pointed out that a fragmented market is not necessarily bad. A fragmented market can actually give rise to innovation. It can give rise to competition. And if you look at the little microcosm of our swaps, our derivatives clearing world, look at what's happened in the rate space, LCH and Eurex, where a year and a half ago it was promulgated by LCH that if you moved certain rates into Eurex, you would never be able to get rid of the spread. Costs would rise, but if you've looked at what the market has achieved, a fragmented, competitive market has shown that the spread is zero, the incremental cost increase is zero, because of innovation, because of competition. If you look at a concentrated market, fair enough, more liquidity in our little microcosm, cross-portfolio netting opportunities far greater, probably more price transparency, but it comes at a cost, and that is why our competition people in Brussels a few years ago stopped a merger between London Stock Exchange and Deutsche Börse because of the anti-competitive behaviour that was feared in the OTC derivatives clearing space. Quite interesting, what if that merger had actually gone ahead and LCH or London Stock Exchange and Deutsche Börse had merged? We've had a bit of a kerfuffle now with Brexit, but trying to untangle that link up. But anyway, it was a destina. It didn't happen. If you look at market trends, I think the big change in globalized integrated financial markets came around 2007, 2008. What you saw in the run-up to 2007 was that the global economy really needed to funnel capital from surplus economies into countries with a surplus of investment opportunities. I think 2007 was the fulcrum of those integrated global capital markets. But now it's in reverse, Steve. It's really in reverse. And I think there are three reasons why. And I think they're all valid. And the first reason is we have larger financial markets. Larger financial markets means more competition, more innovation, which in itself brings fragmentation, but not necessarily bad fragmentation. So the F word isn't always a bad word. Don't tell your kids that. Then there's deleveraging. Tougher capital regulations. We've seen firms shed loss-making activities and assets. I mean, look at our little microcosm of clearing. Look at what happened to the Basel leverage ratio, the net stable funding ratio. We've seen repo sheets shrink, less clearing of repos. We've seen issues there. Capital requirements, second reason, I think, why we've seen this trend towards less globalization and possibly more fragmentation. I think the third reason is the point that was pointed out earlier, and that was the crisis where we've seen that cross-border finance is also an important channel for transmitting crisis from one country to the other. I think that's absolutely clear. And what we've seen is the spillover effects have been picked up by governments, by the Financial Stability Board, and what you see is a very clear and a very honest, I think, approach, and that is governments want to shield their taxpayers from bailing out national sectors from foreign misadventures. So what you see is regulators are protecting their systems. I think that's the third reason why fragmentation is occurring in this area. We see that in the United States. I remember vividly a discussion we had with Gary Gensler years ago when he came up with the CEF, Swap Execution Facility approach. We said, Gary, that's a really spectacularly bad idea. I mean, why on earth do you want to do this? And he cogently explained it was to protect the American system and American investors. So we respect that. We still think it's a spectacularly bad idea, and I think it's we're seeing the back of that and the end of it, but we understood why that was put in place. We're doing the same in Europe. We have a little piece of legislation, you might have heard about it, it's EMIR 2.2, where you see exactly the same approach as shield certain aspects, stability aspects from foreign spillover effects. But there is a solution, and that's the D word. We strongly believe in deference. We believe in deference. We've been giving deference for 60 years. We started that in our integrated market in 1958. I don't think there are many people in this room who were alive in 1958. I was born in 59, so it's a year before my time. We call deference mutual recognition in Europe. And we've not only been applying it to financial services, we've been applying it to fruit and vegetable, tax, car components, everything where you need frictionless trade. Deference.
See that? Sorry to interrupt. You see that clock there?
I do, and I'm not finished yet.
That's how much time we have left. We're going to come back to solutions, okay? And I can't believe it escaped me not to call this panel the F word. I'm not sure why I didn't pick up on that. But with your permission, Steve, you were at the CFTC when Gensler came up with this brainstorm?
I was there, but then I saw what was going to happen, and I left, and I went into the industry. So, but it was in capable hands with Scott. So, okay. But maybe just to follow up on some of Patrick's points, I think you mentioned Chairman Gensler, and I think there really was a protectionist stance by the CFTC when they came out with their cross-border guidance at first. And, it was a very blunt approach, and we've seen the consequences of that over time now. I think it's also important, too, that the CFTC was a first mover at the time. So if you kind of look at what are some of the causes of fragmentation, it's actually the fact that the CFTC was a first mover, put rules out, and then did so in a fashion to try to, regulate everyone and everything, every swap. I've heard it referred to as the intergalactic commerce clause that the approach that the CFTC took. But the good news is now the CFTC has taken a step back, and it really is a time of deference and seeing where the regulations can be made better in terms of going forward. And you saw that with the Treasury report that came out, and it recommended that the CFTC and the SEC strive to improve cross-border regulatory cooperation with non-U.S. jurisdictions where possible to avoid market fragmentation, redundancies, undue complexity, and conflicts of law. And you've now seen that with the CFTC in terms of Chairman Giancarlo's white paper, which was mentioned on a prior panel, where it's recognized that the approach of the U.S. has had some serious consequences on a cross-border basis. And you also see it from the SEC as well. The SEC just proposed a rule related to risk management for security-based swaps. And in that rule, they said that they're looking at a reduction in the possibility of liquidity fragmentation along jurisdictional lines, and that they're endeavoring to take a holistic approach in determining comparability of foreign requirements for substitute compliance. So you really see these themes now from the regulators in the U.S. acknowledging that there's fragmentation and taking that step to see what they can do in order to solve it where you can.
Good. We have buy-side and sell-side representatives here. I think it would be good to kind of hear from them, their views on market fragmentation and how it's impacting their business on a macro basis and on a day-to-day basis. And we flipped a coin, and I think Jenny gets to go first.
All right. So a few thoughts from the sell side on market fragmentation. So I think Shirakawa-san identified a number of different flavors, and I think from our experience, we'd probably add a few more of them. I think really, as Patrick said, financial stability is very important. We understand the needs of governments to set up firewalls and protect their financial system. But when it inhibits the ability of the sell side or the buy side to serve their clients, extend liquidity, that's where it's problematic, and there may be some tweaks that can be made to address those concerns. So I would say there are a few additional flavors from our end. One is liquidity and fragmentation of liquidity, and we've seen a number of examples already mooted today in prior panels. So the leverage ratio and the initial margin offset being one, the trading mandate and being forced to trade on different venues depending on jurisdiction is another. A second example is fragmentation of transparency or information to the market. We talked about trade reporting, also pre- and post-trade transparency. You have different regimes in the U.S. and in Europe, TRACE and MiFID II. And then finally, fragmentation of risk. And this is actually quite an important one, in particular in this part of the world. And you have a number of examples here. One is around closeout netting, which was touched on before. This is probably the single most important tool by which counterparties can reduce their credit risk. And in this part of the world, we don't have a lot of legal certainty in certain jurisdictions that can recognize closeout netting. The second is around CCP recovery and resolution, and in particular uncapped liability, which is an issue in a couple of jurisdictions. And that, again, can force dealer firms to continually pay out into a CCP if a clearing member goes down. So I think those are really important, perhaps Asian-specific issues to explore. I think it's also worth recognizing the work that the Japanese G20 presidency has done, the FSB, IOSCO, Basel. All of them have included market fragmentation on their agendas. And actually overnight, people will have seen that the Basel Committee published a comprehensive compendium of all of their different policies and are consulting again on the collective impact of those policies. So I think there is momentum, moving in the direction to deal with these issues. I think the question is, what is the balance around recognizing where fragmentation is, of course, a necessary part of global markets, but where it's actually having an unintended consequence?
Great, thanks. Thijs, please.
Yes, thank you, Steve. As you already pointed out, we manage $500 billion US. That's a global portfolio. And if you ask me about the impact of market fragmentation, let me just go back in time. During the crisis and just after the crisis, I traded with counterparties in different jurisdictions. I had derivatives traders operating out of our New York office as well. And then we saw the emergence of the Dodd-Frank legislation, beginning of the AMIR legislation in Europe. And that was the first step that made us decide to actually pull those traders back out of New York. Because we felt we didn't have, because we manage a sizable portfolio, but we do that with relatively few people. So we didn't have the capability to comply with both Dodd-Frank and AMIR. And there were, of course, worries about the extraterritoriality and would then our European operations also be subject to Dodd-Frank. So that's when we stopped trading out of the New York office. Then a bit further down the road, I think we canceled trading with all the US counterparties because that would make us subject to that legislation as well. And then going through time, and one of our lawyers is actually in the audience here, and so he had a lot of work because the most recent thing we did was just repapering everything from UK-based entities to entities that were onshore within the European Union. So if you look at our activities, that has shrunk from more or less a global operation to just dealing with local counterparties in the local jurisdiction. I think that says it all.
And a lot of this is second-order stuff, which we talked a little bit about that yesterday, right? It's not, so the broader question here is, yeah, please.
Well, I do have sympathy for some of the statements, the Mervyn King statements of banks living internationally but dying nationally, and protecting the taxpayer. But it almost feels a bit like being an investor of pension asset that we are being caught in the crossfire. Because I would like to invest globally, but all this regulation, and especially a lot of, in my view, things that might have been standardized, but make it very complicated to comply with all the different requirements in the different jurisdictions. And therefore we retreat. We're still wanting to invest globally and deal with global counterparties, but that's being made more cumbersome. For us, developing different interfaces for more or less reporting our derivative trades in 3 different jurisdictions, that's quite cumbersome. And that is something that, because I understand the competition and the innovation, but you're not competing on trade repository, ease of access. So that is, I think, the perfect example where there could be a global standard and just one standard for every jurisdiction.
Which leads to an interesting question, and I think one of the important questions about market fragmentation, where do policymakers draw the line between their justifiable interest in safeguarding their financial system, yet at the same time not putting up barriers to entry and competition, which will ultimately, at least conceptually, benefit their own citizens and consumers? I don't know if I'll throw that open to anyone who dares answer it.
I'm happy to jump in. I mean, I think Thijs raised a really important point around trade reporting. I think the question is, where is it important to have a singular standard where it would not negatively impact the ability of financial services firms, be it buy or sell side, to serve their clients? So trade reporting is one example. Transparency is another. And transparency is important because from a regulatory perspective, if you're receiving different types of information from the same counterparty in different jurisdictions, it may be difficult to see the forest for the trees in terms of understanding whether there are systemic risks in one particular asset class or another particular market or not. So I think that is an important question for supervisors to answer. And actually, maybe it's also worth discussing the S word, which is supervision. I think the JFSA has talked about dynamic supervision and ensuring that all of the existing rules that have been prosecuted over the past 10 years are supervised in an appropriate way, and that supervisory colleges for banks or for other significant counterparties have all of the relevant supervisors on them, so that this issue around protecting taxpayers or ensuring mitigation of systemic risk can be addressed very substantively.
Anyone else?
I think there's a lot of sense in what you say, Jenny, as always. The challenges that the regulators face, and I've seen that as a member of the Basel Committee for 9 years, I see that now in the market space as well, and I've been doing this for 30 years, more than 30 years in the European Union. When I gather 28 member states around the table, I say we have a problem. They all say, I have a solution, follow my law. And that's not the way to do it. And I think a former American Secretary of the Treasury once said, we will not allow our quest for international consistency of rules require us to lower our standards, but we owe it to our financial sector to do our damnedest best to get that in place. And that is why I strongly believe in international standards. where you set the bar as high as possible. But the consequence of that has to be that you then forego applying your own requirements to foreign firms entering your market, whether it is supervisory standards, whether it is reporting standards, whether it's on-site inspections. You have to defer, it's the D word, to allowing the incoming trade, the incoming firm, to operate under its own national system. The key question, is there a limit to that? Is there a limit to this type of deference? We were naive in Europe. In our area of swaps, global swaps, we said, let's do what we've been doing for 60 years in Europe. We allow incoming firms into the European Union. You enter our market of 550 million citizens, 28 member countries, and you do that under the laws of your country, the supervision of your home regulator. We were naive. We thought we could export that across the globe. Most other jurisdictions follow that. One important jurisdiction doesn't. They're now playing catch-up, the United States, the CFTC. Great respect for Chairman Giancarlo and Heath Tarbert, his incoming successor. And we hope that they will catch up at last after 5 years on global deference. But is there a limit to deference? And I strongly believe there is. And that is a limit that governments have set, and that is financial stability. We have that within European Union. I think we'll have to have that globally. The question is, what is stability? How do you determine it? And how do you actually apply that in practice? We gave that a lot of thought over the past 2 years in Europe, and we think that the answer to that question lies in the institutions that actually run financial stability, that are responsible. It's the institutions in all of our jurisdictions that pull out the checkbook if our stability is really endangered. And with all respect, it's not the market regulators. They don't have the checkbook. It's the central banks. It's the central banks that can monitor this. It's the central banks that have to have a much tighter grip, and they need a finger on the button for financial stability in our area. I think that's the only line to deference that we are prepared to look at and that we think makes sense. Otherwise, we strongly believe in full deference, Steve.
I think we are now entering into the implementation phase of the regulatory reforms, and the time is ripe for us to talk about how we can defer to each other in order to make the market more, global market more integrated. And some of the new ideas is coming out. Just Patrick already mentioned. Some jurisdictions are mentioning the importance of the systemic implications when they decide whether or not they will defer to other regulators. So we should not apply the domestic regulations across the board to all the transactions or all the foreign financial institutions. Rather, we need to consider the systemic implications when we apply domestic rule to third country financial institutions or cross-border transactions. Then we can incorporate some kind of proportionate applications of domestic rules to cross-border transactions. By doing these kind of things, we can have some kind of general principles to apply how we can defer to each other. So I'm very much looking forward to having more detailed discussions on these issues at the G20 or FSB or IOSCO.
You mean so different policymakers in different jurisdictions can better align and understand what deference means and how to grant deference and what would be the circumstances? This is like a roadmap for that, yeah? All right, we're going to come back to that. Steve, go back to what you said before and to build on what Patrick said. Is the U.S. catching up?
Yeah, I think it is.
Is that the right term?
I think we're first movers again in terms of deference. I think we like to be out front as Americans. But at any rate, I think, as I noted before, with the chairman of the CFTC, there is really this effort, and you've seen a couple things come out recently. The end of December, there was the comparability determinations for CEFs, MTFs, and OTFs. And, again, I think the words that are coming out are important here in terms of Giancarlo saying that, they've worked together. And I think that's an important theme of all this, too. If we're going to examine fragmentation, we have to get in the same room and work together. And I think the reason the CFTC and the EU could have those determinations is because they did work together. And then just at the end of March, the CFTC had unanimous bipartisan action to approve an amended comparability determination for Japan's margin requirements for uncleared swaps. And this was a case where the U.S. looked back at a prior determination and brought it up to date. So, again, there's this effort to look back and update comparability determinations. And then at the end of last month as well, the CFTC issued a comparability determination for margin for uncleared swaps for Australia. And what's important there is this was kind of a new way that the CFTC looked at comparability, where they conducted, a principles-based holistic analysis that focuses on the regulatory outcomes rather than on the strict rule-by-rule comparison that, again, the current CFTC cross-border guidance has taken. So, again, it's a way to pivot and have more efficiency in terms of comparability determinations. So again, I think that the U.S. has changed course and is headed in a new direction.
Great, thank you. And I just want to add, for the audience's sake, in case anyone thinks that I have any bias in this discussion about market fragmentation, I am a proud citizen of both the EU and the United States. So not Japan or Asia, unfortunately, but so I believe in a level playing field. Let's move on to capital. Jenny. Concerns regarding uneven implementation of the capital framework or even unevenness in the substance of the capital rules. A concern?
Yes, I think you could cite a couple of different examples. One was referenced earlier today, the FRTB, in terms of timing between the U.S. and the EU. The U.S. may not implement before January 2022, although who knows, that could be changing. The EU is on a different time scale, so I think, as Shirakawa-san mentioned earlier, that this timing issue is one that can exacerbate market fragmentation. And then I think probably a better example around capital is around the NSFR. And this is quite an interesting one because in terms of the derivatives liabilities calculation, initially Basel determined it should be 20%. They later recognized that that was too high and gave individual jurisdictions discretion to implement as they saw fit. The EU went with a 5% charge. And this is interesting because it's not fragmentation for the sake of fragmentation. It's a recognition that the initial rule was flawed and may merit revisiting. So given the EU's leadership in this area, this may be something that the Basel Committee and others can look at. And it's totally appropriate, as others have said, 10 years after the financial crisis, when we have the collection of rules now here, we understand how they interact together. If we look at other examples like the leverage ratio in SACR, the uncleared margin rules weren't even around when SACR initially was finalized. So again, going back and looking at a change in circumstances or when new information comes to light seems to be sensible at this point in time.
Yeah. Thijs, from capital to margin, I know there are concerns about the lack of a level playing field when it comes to the some of the responsibilities that buy-side firms have to face with regards to the margin rules?
Well, I think, but that might be less of a topic for market fragmentation. But first of all, the initial margin rules, where now the last phase firms are required to implement these rules as well, where 90% the documentation, has to implement segregated initial margin accounts and set up that structure. I think that's the main issue here. But then relating that back to market fragmentation, because that is a global issue, apparently, somehow, even though the evidence, in my view, is quite clear, it's difficult to get the global cooperation in place to do something about this issue. And that's also what makes me worry about market fragmentation, because I think there's more than enough low-hanging fruit that can make the life of investors like ourselves easier. We spoke about trade reporting. That's not something you compete on, because let's face it, there is some competition in making jurisdictions attractive or less attractive, but that's not something you compete on. On initial margin, what I would call more second-order effects. Do you need to backtest the model, the different eligibility criteria for your collateral? I do not see why that could not be a global standard, and instead of just doing the high-level standard, do also the details, because then it is a lot easier to implement if you want to operate in multiple jurisdictions.
Yeah. Clearing is another example, another area where concerns about the potential for market fragmentation has been expressed, particularly with regards to the L word, location policy, or LP word, location policy. Your thoughts on location policies?
Location policy. Before going to location policy, I very much agree with you and Jenny's remarks on the importance of the considerations to the implementation difficulties or operational burdens before finalizing the international standards. I think if all the standard setting bodies consider more seriously about such a implementation phase before finalizing that, maybe we can think about the more easiness of the implementation by financial institutions, or we can think about not only the high-level policy requirement, but also some kind of data collection templates. If we have some common data collection templates at the global level, all the regulators can use such template to get similar common data from all over the world. So that is very small step, but I hope that can help, that can alleviate the operational burdens currently on financial institutions. Now, with regard to the localization policies, sure, that is also the agenda we should discuss for the market fragmentation issues. But it is a little bit complicated, in my view, because the authorities, regulators, have legitimate concerns with regard to some transactions, especially if those transactions are denominated in the mother domestic currencies, denominated in the domestic currencies, because those transactions can have a systemic impact. On those transactions may need more attention from liquidity risk management perspectives, and also the regulators may think about the continuing stability of the service provisions to the local customers. So I think the localization policies need to be discussed, but we have to think about, we have to consider several issues in order to get a consensus among us.
Did you want to?
I want to talk about line dancing and checkbooks. A couple of years ago, I was in a place called Kansas City in the Midwest. And I went, by coincidence, I was in this huge underground arena, and I was three stories deep, and I was looking at a big dance floor down there, and there were 400 boys and girls line dancing. I've never seen anything like it. The boys were all dressed in the same uniform, white T-shirts, big Stetson hats, Levi's jeans and pointed boots. The girls ditto. And to see this many people actually dance in synchronization was absolutely fascinating. Line dancing is actually the way you would want international regulators to work. You want us to work, dance to the same tune at the same time, so everything is synchronized. And here's the problem. What do you do if one of the line dancers said, well, I'm going to add a little step of my own to it? Or the others are going a bit too fast for me? What happens if we agree in CPMI IOSCO on PFMIs and we say, okay, this is the margin period of risk. This is what we're going to implement. These are our anti-procyclicality rules. This is how we're going to apply this. And one of the regulators goes home and says, well, it doesn't work for my firms. I'm going to do it a bit differently. When you agree international standards, you have to implement them across the line. That's really important. And the second thing is you guys in the industry. So the international regulators agree on margin rules for uncleared trades. Okay, fine. We have an agenda. We have a time frame. We phase this stuff in. And the number of letters I received, I think from you as well recently, sir, saying let's postpone all of this by a couple of years. You have the rules, you have the standard, you have the time frame, and the industry now wants the regulators to put the brake on. That doesn't help us, because what's going to happen is some regulators might want to do this and others won't. So you're creating your own fragmentation in the market. So there is a bit of discipline for the market itself. And then this location policy. You're entitled to your own opinion, but not your own facts. We do not have a location policy in Europe. We do not have something akin to what our Japanese friends do. We have a possibility, if the financial stability of one of our member states or the union is at risk, to take specific measures. And those measures do not include requiring a clearinghouse to locate its entire corporate structure into one of the union member states. It simply requires a clearinghouse to have certain specific services operated from within the European Union. That is not a location policy. So facts before fiction. I've heard a lot of speeches and Shakespeare quotes really completely incorrect, not just the facts on location policy, but what's even worse, the Shakespeare
Why do you
quotes.
think that is? I agree with you, personally, but, you know, it just seems like sometimes the rhetoric gets ahead of the facts in some of these discussions. But, you know, I think people recently have brought up an interesting point, and I want to get, because we only have a few minutes left, to solutions. Deference you mentioned, and that's why I wanted to save your comments about deference to the end. But deference isn't going to solve everything. Deference isn't going to prevent uneven implementation of FRTB by different jurisdictions from a timing standpoint. Deference isn't going to prevent the Basel Committee from saying it doesn't have to be 20, it can be 5 and 20, and you can pick, you know, which people scratch their heads about. Deference isn't going to solve the problem of buy-side firms in Europe and Japan having greater responsibility for backtesting and validation of models than they will in the United States, right? So in addition to, and I agree that deference is a solution, what are other solutions that the official sector or the market participants might be thinking about? Is the gap between the framework that the global policy bodies formulate and the implementation, is it too great? Do they need to be more granular? Heaven forbid. But I mean, you've been on a lot of different policy committees. Other solutions you see?
I think balance is important. You don't want to go back to the Basel II days of mathematical formula.
Right.
It's too granular. You need something in between. The second thing is, one of the problems that we have is that once we've adopted these rules and requirements, we walk away from them. Maybe we should, every 12 months, have regulators look at what we adopted. How did we implement them? Do they still make sense? Are they actually responding to the problems we sought to sort out? Regular reviews, I think that helps. A greater interaction with the industry. So these are wonderful events. Wonderful events. I had an event in Chicago. There was an event in Boca Raton. There was one in Naples, Florida, and many other events we've been to as regulators in the past. Why don't we have a similar event with the regulatory community? Why don't you have the CPM-IOSCO board sit here with you guys and work this through together? We don't write these rules for you or because of you. You're not there for us. It's the other way around. So that interaction could be improved. Just a couple of first responses.
No, that's great. And you know, in our white paper, we articulated what you just said, that regular reviews by policymakers of rules is just a great thing. And can you give us some insight into the paper that the Japanese G20 presidency is drafting in terms of potential solutions? Without giving away the story, it would be great if you could tell us a little bit about that.
Yes, I think that the focus has been already, I explained the 3 or 4 areas. One is the difference or recognitions issues, and the second one is ring fencing or prepositioning issues. The third one will be data requirement overburden on the financial institutions. And the way forward is still we need to discuss among our regulators, but the general sense of our discussion is focusing on the pragmatic, practical solutions. For example, we need more cross communication at the various stages. The first stage is international standard setting stage, and the secondary national rule making stage, and third one is supervisory corporations. At each of these stages, we can communicate more closely, and I think we can be better in terms of the market fragmentation, I believe.
Great, thank you. I see that we've run out of time, and I think all that's left for me to do and for you to do is to thank our panelists for a great discussion. Really appreciate it. Thank you so much.